Hey, what's up guys? So in this video I'm going to show you how people make big money with options. Now there is risk to options. Any option that you buy, you can lose whatever you're investing into the option. It's not like a stock. A share of a stock, a share of a company you can hold pretty much forever as long as the company doesn't go bankrupt. Now with options, every option contract has an expiration date, and the closer the expiration date, the riskier the option is, but that also increases the potential for gains. So I'm going to show you how big money is making big money and how the rich continue to get richer, and also how the smart people, the little people like you and I, can make money off of what the big money is doing. Now, here we have, it's called FlowAlgo. It's an options screener. It shows options flow. So it basically shows the activity in a particular option, and it gives a lot of really good data. This service is not free. You have to pay for it. I do have a link in my bio if you want to try a free, not a free, I think it's a 25-day trial for $25. After that, it's like $100 a month if you want to keep up with it. But the deeper into this game you get, you're going to realize that this is absolutely necessary for understanding what big money's doing. So I'm going to show you an example. So today is Tuesday, October 13th. And yesterday was Monday. It was the first trading day of the new week. So let's look here. So on Friday, October 9th, we had call activity in Apple. So you can see it shows, I wish I had a little mouse or something, but I'll just highlight it. So here it shows the expiration on the left, which is the day that the contract expires. It shows the strike, which is 120. Call or put, which is the C or P. So it was a call. And when somebody buys a call, they expect it to go up. You're basically betting on the stock is going to go higher. Spot is the price that the person bought the option at. I'm sorry. Spot is where the underlying stock, which is in this case Apple, that's where the price was when they bought this 120 strike. Details, it shows they bought 500 contracts at $1.25, and the value, if you can see at the top left hand corner, was $63,000. Another order below, $64,000. 61,000, 73,000, 71,000, 68,000, 70,000, 70,000, 82,000. Okay, so we can tell that this person is likely the same buyer, because of the way that they're buying their contracts in lots of 500. You got 515, 520, 501, etc. Not necessarily the same buyer, but that doesn't really matter. But we can see on Friday there was a lot of call flow. And on Friday, let's look at the stock. Let's see what it did on Friday. So let's go back to 4-hour chart here. So this was, where are we? Now let's do a 1 hour. So this area here, was Friday. You can see at the bottom it says 9 o'clock. That's when the market opened. And then, like you see these gray bars at the bottom, that's basically the time that the market's open. The gray bars represent volume, which is the amount of shares that are traded in the stock. So at 10 a.m., so it's right around here, was when that call buyer was loading up on their options. It's probably over $1 million worth of options there at around 116-ish. Okay, so they were buying calls at around this price. Friday was relatively flat, but it was a green day. So Apple was up on Friday. The anticipation for the Apple launch, which is going to be released today, is one of the main reasons why there was so much activity in the call options, because big money knows where this stock is going to go, so which is higher. So they loaded up on their calls, and then towards the end of the day, towards the last hour of the day, it broke out of the trading range here. So it was stuck in this range. I'll just draw a little rectangle here so you can see and visualize it a little better. But it was stuck in this range here pretty much the whole day. All right. And then towards the end of the day, we started to see the stock break out, and it broke out above the highs, which was 116.63, and it closed at almost 117, so 116.98. And then in the after hours, it kept pushing higher. So as soon as I saw the end of day action, I knew that Monday was going to be green. Why? The catalyst for the iPhone launch, all the call activity, etc. So boom, there goes into the after hours, and it goes higher into the after hours. Now, Monday morning, this area here is all pre-market, and it just kept pushing higher and higher. Then the stock opened on Monday, and it gave a chance for people who didn't get in on Friday at 117 to get back in at a low of 119.28, which was very short-lived. Didn't last very long. It dipped for a few minutes, and as you can see, it just climbed higher and basically closed up from 117, and it closed at 124.40. Okay, so the stock itself made a move of 117 to 124, so that's $7.40. Okay. Now, if you, let's say you owned, 10 shares, you made $70, right? Now let's just say, let's put this into perspective. So let's say you had 10 shares, and let's say you bought it at 116 on Friday, and you had 10 shares. So you invested $1,160. The share price went up $7.40 times your 10 shares. You made a profit. Well, if you sold, you made a profit of $74 at the end of the day if you sold your shares. If not, you held your shares. It's a longer term investment. Boom, you're up $74. Okay, which is what your original investment was, 116 times 10. So divided into 74 divided by was it 1180? So you made around a 6% return over the weekend, okay? If you held to the end of the day on Monday. All right. Now let's show you what happened to those options. So remember these options, those 120 call options that somebody was loading up big on Friday. And also there was a lot of option volume in that strike even before Friday. But anyways, so then let's look at what happened to the option price. So this is Thinkorswim mobile. You can view your stocks, and you can view the options chains and all that stuff. I'll make a video on that next time, but I just want to show you what happened to the option. So let's go to, so it's October 16th, and they were buying 120 call options. So let's view that detail. So this was Friday, all right? So they were buying Friday around $1, what was it? 128, 125. So let's say $1.25, okay? So they were buying at $1.25, right down there. And the option at the end of Monday was priced at around $5.50. So they bought $1 million worth of options at $1.25, and that same option was worth $5.50 at the end of the day. So let's do the math on this one. So it's nuts. So they bought the contracts at $1.25. With options, everything is times 100. So in reality, that option, that one contract cost $125. Now they bought several hundred of them or several thousand because they just had 500, 500, 500. So they just kept buying it. So let's just say you bought one option, okay? Let's just say you went very conservative and you paid $125 for a relatively risky option which expires October 16th, which is the end of this week. Now, weekly, again, like I said, weekly options are very risky if you don't get the direction right, and if you don't get the speed of that move correctly, you will lose the money that you put in. But in this case, it was a winner. So $125 is what the contract cost you. At the end of the day, the contract was worth $5.50. Now, you're timesing that by 100 because every option contract is based on 100 shares, basically. So $5.25, $5.50 times 100. So that your contract now is worth $550. So you bought one contract at $125, and now it's worth $550. So you are up. Let's say you held it at the end of the day. Maybe you sold it earlier. Fine. But if you held towards the end of Monday, your profit is $425. Okay. So let's do the math on that. So on a $125 investment, your profit was $425. Was it 125 divided by 425? So you made, no, sorry, 425 divided by 125. So yeah, so you made 340% on your return. So let's say, so you invested $125 times 0.340. Yep, is 400 and so we're just moving the decimal to the right. So $425 profit on $125 investment. All right. Now let's just say instead of you in our original investment, you bought 10 shares of Apple at 160. All right. At 116. Let's say you took that 1100 that you were going to buy 10 shares with, and you divided it up into the contract. So let's see how many you could afford realistically. So if the contract was 125, you could have, let's say you bought 9 contracts. So you bought 9 contracts at 125. So your investment was 1125 into these weekly options, which are very risky. If the stock didn't go up the way that it did at the speed that it did, you would likely be losing money due to factors such as theta, which is something that is called premium decay on your option. So again, these are things that I teach in my course, and I explain everything, exactly what you need to know, what you need to avoid. But let's just say you put 1125 into this option, and you swung it into Monday, and let's say you held it towards the end of the day. Fine. Now we're going to do the 9 options. So you bought 9 contracts, and the contract went up. So it was 550, 125. So the contract went up for $4, basically $425 times you had 9 contracts. So off $1,100, you made $3,800, which is, again, it's over 300% return on these options. So that's only 9 contracts. All right. Now let's go back to this example. This person bought, whoever this is, they had Their first buy on on Friday was $82,000, $69,000, $70,000 worth, $68,000 worth, $71,000 worth. Someone at the end of the day at 3:59 bought $167,000 worth of 117 strike call options. Okay. Let's look at that example. So real quick. So 117 strike, which expires this week. We're going to go back to the options chain on Apple. This is insane, guys. 117, boom. Look at this. Closed up at around $8. So they bought $167,000 worth of contracts at $2.68. So they bought 622 contracts. And at the end of the day, it closed at $8. So let's do the math. So this is cool. So $8 minus their $2.63 per contract. So it was a $5.37 gain per contract, which is really times 100. So it's really $537 gain per contract. Now they bought 622 contracts. So man, it's about to blow your mind. So 622. So they made, this is nuts. They made what did they make? Times 3. They made like, hold on. These numbers are huge. So they made 167,000, and it went up 268 divided by 8. 8 divided by 268. So it went up times 3. Yeah. So they had $167,000 investment. It went up times 3. So they made like $500,000 on this one trade over the weekend. So this is the power of services like FlowAlgo, but not only that, this is the power of options. Again, options can be very risky. They are very risky if you don't know what you're doing. But I'm here to show you what they are and how to use them for your advantage. And as I said, options have expiration dates. So there's a bunch of options you can buy. You can buy options out to December of this year. You can buy options out to April of next year. Now, the further you go in time on an option, the more expensive it's going to be. But I just wanted to show you, how a $7 rise in the stock can turn into a 300% gain for you if you're playing options and if you know what you're doing. So that's it. Hope you enjoyed the video, and I'm going to be posting more about it, and hit me up if you have any questions.